All right, so tonight we're going to do chapter 7. Chapter 7 deals with accounts receivable. Has anyone worked in accounts receivable, or has anyone worked at a store behind a register collecting money at the register or in accounts receivable? Okay. Okay. So nobody really had anything that they would charge or do on credit, or like a store credit card?
I mean.
Or was it just cash and debit card?
I guess it would just be considered cash sales.
Okay. Has anybody had any experience with credit sales at all? No? Okay.
Yeah, I probably have.
It's an asset. We talked about that in one of the first chapters. And it's an asset. So it sits on the balance sheet under the asset section. And because it's an asset, what is its normal balance? A debit or a credit? Debit. So we normally have a debit on the account. So the interesting thing about accounts receivable and accounts payable, they're very similar in the way that they're set up in the system. So we have a computer system that has a list of the accounts. Remember, we looked at what it looks like when you see a list of the accounts. Chart of accounts is what that's called. And then we also looked at the general ledger details. So we can pull out a report that gives us a list of all the accounts. One of those accounts is going to be called accounts receivable. Now, when we sell to a customer that buys on credit, we have to be able to distinguish, if Joe bought this or if Bill bought this. We have to be able to distinguish that in a report in order to know who owes us money. So when you're looking at a general ledger, all you see is a dollar amount, and the dollar amount is going to include all of your sales that were on credit. So I wanted to show you what it looks like when you run a report. So the way that the software works is you'll have a source document of some sort. Maybe it's a sales invoice that you have, or it could be something different, but a lot of times it's a sales invoice. And on there will be some services or parts that you're selling. When that goes into the computer software, you're entering the name of that customer, and that customer will be linked to your accounts receivable module. So in the software, it'll have accounts receivable module. And so when you put that sale in, you're identifying, okay, I'm selling to Joe. Over here, I'm selling this bicycle. And then over here, I have Bill, and I'm selling Bill a lawnmower. So you'll have multiple sales going into the accounts receivable module, but it's identified by everyone having their own account number. And usually the company decides how they want those account numbers set up, but that identifies specifically who bought what merchandise or services, how much do they owe. And at any point, if I wanted to run a report, I could run a report and it'll give me a list of all of these customers. And it'll tell me in detail what they owe. How old are those invoices? Are they within 0 to 30 days? Or are they older than that? And so a lot of times, at the end of the month, you may want to look at that. And that's what you have collections that will go through those reports. They'll look to see who's got old invoices. Who do we need to call and try to figure out why they haven't paid the invoice? Is there something wrong with the product or services? Is there something that we need to do to fix whatever so we can get paid? Is it that they didn't get the invoice? So a lot of times if you're using mail, we've had a lot of issues with mail since COVID, and especially with the storms that we have here, sometimes we have problems. And so we can now email out our customers those invoices and get those paid. And so there's a lot of different reasons why maybe they haven't paid yet. But you want to be able to identify that, right? So you want to see a report. But know that on the general ledger side, all you see is one account. Let's say it's 1,200. That account number is set for accounts receivable, and that is called a control account. So everybody that owes you money is going into that control account. But then you kind of have like a little sub of that account where you can list out on this report all of the invoices that are still open. So you'll have a list of what's open and how old is it. So I wanted to show you an example of what that looks like. So this is Craig's Design and Landscaping Services. So you'll notice on the top, it tells you what's current, tells you what's 1 to 30 days, 31 to 60 days, 61 to 90 days, and then 91 days and over. Then you have a total. So if they have multiple invoices, you know, and the due date is in different dates, you could potentially have multiple amounts, and then the total gives you the total that's owed from them. So can you see that, or do I need to blow it up? So Amy's Bird Sanctuary, there's an invoice for $239, and she purchased that within the last 30 days. So it's listed out. And then we have Bill's Wind Surf Shop. He has an $85 invoice he hasn't paid yet. It's between 31 and 60 days. So we can go into the accounting software and say, we want to get a report of all of our accounts receivable, which is people that have bought on credit that have not paid yet. Maybe they bought on credit, but they've paid, they won't show up here. Does that make sense? This is just the outstanding balances. It's an accounts receivable aging. And so it gives you a summary. And depending on what kind of business you work for, it could be laid out a little bit different. It could have a little bit more detail. So that's one example. And then this is another one. So you'll see, oh, wrong one. Why do I keep hitting the same one? Where'd it go? Must have closed it when I hit it. Okay, so you'll see that this one's laid out just a little bit different, and it gives you that customer name. So you notice that they'll have the different columns that it shows you the amounts, and then it has an amount that's due. So the amount that's due in total, so once you look at the whole report, maybe you have 20 to 50 customers on there, who knows what it is. But at the end, you're going to have a total. And that amount that's outstanding should match what's on your general ledger account 1200. Does that make sense? So even though we have a report, everything's detailed out, telling us what the customer is, when we're looking at the general ledger detail, we're just going to have amounts going in and out through the month. So the amount goes in, somebody makes a payment, what happens? We have to credit that off. We don't want to show it open anymore, right? So as people are paying, we're crediting off accounts receivable for that particular customer or tenant or client or whatever it is. And so in the end, if I want to run this report at the end of the month, I will get a number, and that number is going to tell me the amount that's outstanding still, how long has it been that we've sold, how long has it been outstanding, and then what is the total, and that total should tie into your general ledger. Okay, so we call that a control account. And we'll talk about that again when we do accounts payable, but I wanted to give you an example of what it looked like. Does that make sense? Do y'all have any questions about accounts receivable and the general ledger and the reports? Okay, so we have a business, we can sell on credit. When we sell on credit, we're agreeing that we're going to give them the products, we're going to, provide the services, and then we're giving them a set terms. Remember, we talked about net 30 or 2% 10 net 30. We're saying, okay, here's your credit terms, and we're going to let you buy this on credit. So they get the services they need. And then in that time period, hopefully they pay you. So sometimes there's a process of going through and running credit checks on the business to make sure everything, looks like a business that you would want to be able to sell on credit, right? You don't want to sell on credit to people that have bad credit that you're not going to get paid. You'll be out your product and your services. Okay, so we talked about the control account. that report that we looked at is the supplementary record. So that's just giving you the detail. We just looked at that. And then the schedule of the accounts receivable. So just know that you'll have a list that tells you everybody that is outstanding, and that number should tie into your general ledger. So hopefully that makes sense when we start doing journal entries. Okay, then we have sales with bank credit cards. So you worked with a cashier. So if you're working the cashier, there isn't a credit sale if they're paying you cash. You're just receiving cash into the cash register. Well, now what happens if I go to Macy's? When I go to Macy's, I can pay cash, or I can pay with my own debit card, or I can pay with a Macy's card. So there's a couple of different things that can happen. So let's talk about the bank card. So Macy's has an agreement with Visa, MasterCard, Discover, that they'll take those cards, but they're going to pay a fee to Discover, to Visa, and they make that arrangement. So what happens is they have an advantage because when they get paid, they're getting the money right away. They're not waiting for that money to come in 30 days if they sell it on credit. So in the next couple of days, they'll have those deposits coming through from all of the purchases that were done with a debit card from a bank. But they lose a little bit, or they lose a little fee. So we're going to walk through some examples with that. Also, Macy's has their own credit card. So if I paid with my Macy's credit card to Macy's, are they getting the money right away just because I paid my credit card? No, I'm buying that on credit. And they're relying on me to turn around and pay that. Sometimes it's a minimum amount, sometimes you pay the whole thing, but there's always a minimum amount that will come through on your statements, right? So they have an accounts receivable at that point with my name on it. And they say, okay, this is how much Jennifer Hinton owes. And then when I make my payment, I expect that that money is going to get applied to my account, not just anywhere, right? So then the next statement that comes in, if I paid it off, my statement shows I don't owe anything. And Macy's has received their money at the time that I make the payment later, not at the time of the sale. So there's a couple of different things. All right, so let's look at one real quick. All right, so let's say we have a sale on credit. It's for $950. And let's say we sold it to this comp store. So when I make a sale, credit sale, what's part of my journal entry at that point? I haven't received the money, right? So I can't debit cash. I didn't receive cash. So what am I debiting? I'm selling it on account. It's a credit account. Anybody know? I'm debiting accounts receivable. So I have accounts receivable. Now remember, it's going into that one general ledger account. Let's just say it's 1,200. A lot of times you'll see the number and a description of what that account is. So I have accounts receivable to who? I need to identify because my system's going to identify. It's going to be comp store. So now we're manually doing this for class, right? We're manually having to do the journal entry. But you're not going to have to manually do a journal entry probably 99% of the time in today's world. Your computer is going to do it for you. So when you enter the information like Jennifer Hinton, account number 100, the sale of a dress for $100, all that's what you're entering on this date, that's going into the system and it's creating that invoice and then it's billing me. So internally, this is what the system's doing. It's saying, okay, we have an accounts receivable. They're going to pay me later. Let's go into my account, my control account. Comp store is who we're selling to for $950. And then I have my sale for $950. So that's my sales side of it, right? And that records my sale. So it's that easy, just debit accounts receivable, put the name of the customer, how much did you sell it for, and then we have the sales side. Now, we went through, if this was merchandise, we would have costs, and we'd have to do that part too, right? So let's just say my cost is $700. Let's say I bought a product. I sold a product to comp store. So if my cost is $700, my debit's cost of goods sold, 700. And my inventory, 700. So that's if I sold something, a product. I would have to take it off the shelf, right? So if I have something, a dress on the shelf here, and I sell it, I have to get rid of that off my inventory because I don't want it to show up. Okay, so that's a credit sale. All right, let me get an example of, I want to do one with a bank card to show you the fees. Okay, so now we have TechCom. It's a $100 credit card sale. It's got a 4% fee. And then we get the cash immediately because it's a credit card where we're receiving the cash right away. It's not our own card. Okay, so if we have a $100 sale using a credit card, I've agreed that if I take that bank card, I'm going to pay the 4% to the bank. So that becomes an expense in order to get my cash right away. So I don't get the full $100, right? But I have to record my sale for $100. And I want to record how much cash I'm receiving. And I also want to put my expense in, all at the time of the sale. So when I do my journal entry for this, I'm going to have cash coming in of $96. And then I'm going to have a bank fee or a credit card fee. I may stick with what they use here because it might be the same in the homework. It's a credit card expense. For $4. And then I have my sale of $100. So you see how it's a little bit different? So now I'm getting the money right away, but I'm not getting the full amount. I'm getting, the $100 sale, but I'm not getting $100 in cash. So I'm recording my sale for the $100 because that's how much I sold it for. And then I want to record my expense for that 4%. So it's just $100 times the 4% to come up with the fee amount. And that's what goes to my bank fee or my credit card fee or my credit card expenses. And then the difference is my cash because I'm getting that right away. This is assuming that when I have the sale, the money is just coming in right away. A lot of times it doesn't happen that quickly. Okay, so a lot of times with some of the banks, they will send you a statement at the end of the month and you'll have one dump in at the end of the month. Sometimes it's daily. Sometimes you'll have a deposit that comes through daily. And so you'll have to have a list of all of your sales that you sold on Visa or Discover. And that way you can tally it up and reconcile back to what money you're getting from the bank. Because you want to make sure you received all your money. All right, do y'all have any questions about that?
Yes, is it sale or revenue?
Yes.
Okay.
So the question was, is sales revenue? Yes. So if we sell something, that is definitely revenue. So that credit to sales could say a credit to revenue. Just depends on what you want to call it. Okay, so then we have sales on installment. So it's an amount owed from credit sales where the payment is required in periodic payments over an extended time period, which means you'll get interest. Okay, so usually, not all the time, but usually the customer pays interest. Depending on how long that installment is where it would show up on your balance sheet. So this is an asset because it's going to benefit you in the future. So you're going to collect money on this installment. And if it's all due within 12 months, it's going to be in the current section. So remember, to go into the non-current section, it has to be over 12 months. Okay, and we'll look at one of those. I think we have one of those in the homeworks. We'll look and see. Okay, just because we sell on credit, I know it is hot. It's very hot. So we've sold some products and services on credit. Not everybody's going to pay. So we have to determine how are we going to account for that? How are we going to account for that loss? That bad debt is what we call it. So we'll have some different methods that we're going to look at with bad debt. There's a couple of different ways we can do it. So one is called the direct write-off method. So that means that if I have Joe that owes me $500 for a lawnmower and he never paid me, it's now over 90 days. I've tried to collect. We've called, we can't get a hold of him, phone's not in service anymore, you know, we had somebody go out, look at the address, can't find him. He's just gone. So we want to write this off. What the direct method means is, I'm going to directly write off that accounts receivable as a credit because it's sitting as a debit. I have to do a credit to his accounts receivable for Joe. And then the offset is the expense, the bad debt expense. So I'm going right to the expense. And we'll look at a couple of those with the homework. So if I'm writing off in a direct method, that means that I am going to write that expense off when I determine that that accounts receivable is not collectible. I've determined it's bad debt. I'm going to expense it. It's $500, bad debt expense $500, a debit, and I'm crediting accounts receivable Joe $500. So I just took it off my report. No longer on my balance sheet in 1200, which is my control, the accounts receivable. I've gotten rid of off of there, right? I don't want to show it on my balance sheet because he doesn't owe me that money anymore. I've decided that I'm not going to collect it. So I'm pulling it off and then I'm setting it up as an expense. So that reduces my revenue. Okay, then there's something called the allowance method. Allowance method is a little bit different. It's not something that I'm going to determine during the year. Oh, this one's not collectible, I need to do this. Those types of things will happen, but that's not how I'm going to record my expense. So for the allowance method, we're recording the expense differently. We are going to now have an account called allowance for doubtful accounts. So that means that I'm going to have some accounts that, I'm doubtful that I'm going to collect these. So I have an account that's called allowance for doubtful accounts. And that account is going to get an estimate at one time during the year. And then I will adjust that as I go. I'm not going to expense it during the year. I'm going to expense one time, go to my allowance account with it. And the allowance account is what I'm going to use when I determine that something's not collectible. So let's look at those real quick. So my direct method is I'm recording the loss when it's determined to be uncollectible. And I'm going to go over if they decide to pay it later. So we have a customer that owes $1,000 and it's deemed uncollectible. So what is the journal entry? We're doing the direct write-off method. So I'm going to go bad debt, expense for $1,000. And I'm going to remove that accounts receivable, whoever it's for. I'm just going to use Joe because I didn't put a name, for $1,000. So I've just removed it off the books. That's my journal entry. Now, that's how I'm doing it in class. Let me just make a little note that if you're using a computer system software, you won't have to do a journal entry for that. You're going to have to do all of your adjustments through transactions within the accounts receivable module. So remember I told you in that module, when you make a sale, you'll be putting in the customer name, the account number, date, amount. You're entering all that in the computer. So it knows okay, I have an invoice outstanding for this customer. If I determine that I'm not gonna be able to collect that, I have to do a credit memo in the software. When I do the credit memo, I'm crediting his account, that $500, to remove it off of there. Now it's no longer gonna be on my accounts receivable aging, and it's gonna be removed out of my accounts receivable. This is what's happening. I probably have a code that I'm gonna use when I do the credit memo for $500. So this time I don't have a product that I'm getting back, right? I'm not gonna have that number or that service number. It's not going to revenue. I'm gonna have a different number. Maybe it's BD for bad debt, and that BD code is linked to my bad debt expense account. So when I do the credit memo, the computer does this. So this is the entry, bad debt expense debit for the amount, and then accounts receivable for that particular customer for the amount. Okay, so let's look at the allowance method. The allowance method is a little bit different. Remember I said this is an estimated amount that we're gonna set up. So it's an estimated loss from uncollectibles against sales. So I can determine a percentage of my sales that I'm gonna deem uncollectible, and then produce that allowance for doubtful accounts. That's one way. There's also another way, which is looking at a percent of my accounts receivable. So let's just do the journal entry. Let's say we've already estimated at the end of the year or beginning of the year, what is my allowance going to be? My allowance for doubtful accounts. I've already set that up. Now we'll go through setting it up in a minute, but let's just say we did that part already. So we've decided that Joe is not going to pay that $1,000. And so we need to remove it. The direct method, we go right to the expense account. Allowance method, we go to what? What you think? Anybody have a guess? Okay, so remember we were saying that this is an estimate that we set up once a year normally, and we set up an allowance for doubtful accounts. So the money is just kind of sitting there until I'm ready to write off. So if I'm not doing the direct method, I'm doing the allowance method. I normally would hit the debit bad debt expense, but if I'm doing the allowance method, what do you think I'm debiting? Not bad debt expense, I've already done that, but it's the allowance for doubtful accounts. So I'm doing the same entry where I have to remove my accounts receivable. The only thing that's changed is I've already estimated it, so I've already expensed it. I don't have to do it again. I'm gonna offset what I've set up as an allowance. So I'm debiting allowance for doubtful accounts, 1,000, and I'm crediting accounts receivable for Joe, 1,000. Let me push it over just a little bit. Okay, so that's what I would do. Both methods. I've determined that someone is not going to pay me, and it's going to be a bad debt. If I use the write-off method, direct write-off method, I'm writing off to bad debt expense. If I use the allowance method, I'm writing off to allowance for doubtful accounts. Okay, other side is both times it's the accounts receivable. So we have two different ways of doing it. Write-off, direct write-off, and the second one is the allowance method. Now I mentioned we have two ways to estimate the allowance. So remember, we only do this if we're using the allowance method. And there's two different ways we can do it. One, we're going to be looking for a percent of sales. So that's the percent of sales method. Compute as the percent that we decide that we're not going to be able to collect, and we multiply that by the sales. So the problem will give you the sales amount. it will also tell you what the percentage is. So all we do is take the sales, multiply it by whatever that percentage is. That amount is what I'm gonna set up. I'm going to expense it in bad debt expense when I calculate that amount. Whatever it is for, the sales times the percent, that's gonna be my expense. The credit's the allowance. So if I'm sitting with a credit, you see how this entry we just did, we're debiting allowance. So as you're going through the year and you write off accounts, we're debiting. And so we're reducing that amount as we go. Sometimes you might write off more than your allowance. Sometimes it might be less. It's just an estimate. And you'll always adjust for the new period. The second way is a percent of accounts receivable. So we're going to look to see how much of accounts receivable do we think we're not going to be able to collect. And it could be real simple. We just take the amount and multiply it by the percent. Or it could be a little bit more complicated where we've set up a tiered, and you'll have to do this for homework. Probably not on a test, but for homework, you'll have to do it. Maybe I've decided different percentages for the different days that it's outstanding. So if it's 0 to 30, I know that I'm going to be collecting that. So it might be a really small percentage. But then when I get to over 90 days, I'm like, okay, well, it's unlikely I'm going to collect it at this point. So my percentage may be a little higher. So you'll have a tiered. As you go, the older it gets, the higher the percentage gets. Because it's it's very likely you will not be able to collect on that old stuff. The older it gets, the less likely you're going to collect it. All right. So let me see if I can get some numbers so we can do an example. Oh my gosh, it is so hot. Okay. No. Estimating. All right, let's do this one. So we have Music Land has decided that they're going to estimate it on sales. So our credit sales are 400,000. And it's estimated that 0.6% of the credit sales will eventually be uncollectible. So we're going to say 0.6% is what we're estimating uncollectible. Does that make sense? We're saying, okay, we have 400,000 in sales. And I've decided that based on history, we're not going to collect 0.6% of that. So how do we calculate our estimate? We just take the 400,000 in sales, multiply it by the 0.6%, and the amount is going to be 2,400. So that is the amount that I want to set up as my allowance. I'm just taking the sales, multiplying it by the percent, and now I'm ready to set up my allowance. So since I've determined what the amount is, I know now what my bad debt expense is going to be for the year. Bad debt expense, 2,400. And I'm setting up my allowance for doubtful accounts. 2,400. Okay, so I'm recording my expense for the year. Now, as I go and I determine somebody is not going to pay, it's going to be uncollectible, then I would do a debit to allowance for doubtful accounts and credit that accounts receivable, like we did a minute ago. All right, let's look at another one. The percent of receivables. Percent of receivables is a little bit different. We're still going to multiply the receivables by the percent, But we have to look at one additional thing when we do use this method. We have to consider what the balance is already in the allowance account, because we're not just saying, okay, it's a percent of the sales and that's my number. We're saying we want the number to be a percentage of our accounts receivable. So whatever that number is, that's what I want in the allowance account. Sometimes it has a balance, a credit or a debit. Let's take that into consideration to come back to the number that we're going to calculate. All right, so Musicland has 50,000 in accounts receivable. The balance in the allowance account is a $200 credit. So we'll need that for this calculation, but not for sales, okay? And we determined that 5% of accounts receivable is going to be uncollected. Okay, so we're going to do the same thing. We take the sales, multiply it by the percentage. So we'll have 50,000 times 5%. This is what we want our ending balance to be. So here's our allowance count. What is the balance in the account? It gave it to us, $200 credit. So here's my beginning balance, $200 credit. So when I do my adjustment, am I doing the full 2,500? The 2,500 is going to be a debit or a credit in the accounts, the allowance account. When we set it up, it's going to be a credit. We want it to be a credit balance. So we want the balance to be 2,500, but we already have 200 in there. Yes, we're going to subtract and get the difference. So we don't need to put the whole amount. We only need to do an adjustment for 2,300. Okay, does that make sense? So the difference is what I'm setting up as my journal entry. So I do bad debt expense. Now this part is exactly the same as doing the sales method. The only thing you have to consider is you can't just take that number that you just calculated and that's your number for the journal entry. You have to consider what's in the allowance count already, because this is what we want the ending balance to be. So we have bad debt expense for 2,300, and we have the allowance for doubtful accounts, 2,300. So here goes my entry, and my ending balance is 2,500, which is what I wanted. Okay, so we have the direct write-off method, where during the year, when we write off, we're going to do a journal entry to bad debt expense. Debit bad debt expense, credit that accounts receivable for the amount. Then we have the option to do the estimated, the allowance method. Two ways. One's the sales. We're looking at sales for the period, multiplying it by a percent, and that's the number we use. When we do the journal entry, we debit bad debt expense, credit the allowance account. If we're doing the percent of receivables, we're still calculating the percent of that receivable, but we're looking to see what's in the account. So let's say I said there was a $200 debit balance in the allowance account. What would my entry have had to be? You would add it. So it would become 2,700 is my adjustment. So that way I could get my credit balance to be 2,500. I have to have it in there as a credit because what's happening during the year when I deem that they're uncollectible, I'm debiting allowance and I'm crediting accounts receivable. So it has to be a credit when we do the estimate. Okay, are y'all confused or y'all okay? Does it all make sense? Okay. Let's say we have all these accounts receivable and we're short on cash. We need some money. So we can sell our receivables. Basically, we're just selling them to a company that will collect those receivables and we'll get the cash right away. A lot of times there's a fee for that. So it's called a factoring fee, and that's an expense. So that money we'll figure out what that fee is. We'll calculate it. Usually it's a percent of whatever those accounts receivable are. Sometimes it's a flat rate, but a lot of times it's a percentage. So we're going to convert it to cash, let somebody else collect. We get our money up front. And then we can also pledge our receivables. So maybe we don't want to sell them. We want to borrow some money and use the accounts receivable as security. So I don't know if you've ever done a loan and you've needed something as collateral. Sometimes you can get little small loans and use something that you have that they would be able to resell. Maybe a couch, car, right? You can use that as collateral. This is the same thing. So you can use your accounts receivable. You can pledge those. You won't have to sell them as long as you make your payments on your loan. You default on your loan, then they will take your receivables and try to collect on those. That's how they'll get their money back. I made a note here. Remember we talked about the disclosure principle? So we have the financial statements. It lists out all your balance sheet, your income statement, statement of retained earnings, cash flows. You have all those statements. But sometimes the numbers don't always tell you everything. We have to disclose it in the financial notes. So this is one of those items that if you have receivables on your balance sheet that you've pledged, and so now you have a loan and that's collateral, you would have to disclose that so that whoever is looking to invest in your company, they know, okay, if they don't make a payment on this loan, they're going to lose their receivables. They won't have that cash. And we'll do a homework problem with that. Okay, this is our formula that I want you to remember for this week. It's the accounts receivable turnover. So it's measuring both the quality and the liquidity. So the quality is how likely is it that we're going to collect? And the liquidity is how fast are we going to collect on it? So it's net sales over average accounts receivable. Okay. Look at some of the homework problems. Do y'all have any questions before we start the homework? Do y'all like learning about accounts receivable?
It's actually not bad.
It's not too bad. I'm understanding a lot more of this than I was before the first step.
Well, because you're hearing it a little bit more. Some of it's repetitive, so that helps. And now we're kind of breaking down into more detail.
So when you had asked the question earlier about like what account it goes into when we're debiting it, I almost said accounts receivable, but I was debating that and payable. What's the difference? Like,
So a payable is when you have to pay somebody. So it's an accounts payable. It's a liability. So you're liable to pay. The accounts receivable is an asset. And that means it's an account that you're going to receive money on in the future. So I try to use the words to try to help you understand. The accounts receivable is when you're selling your services or products, and you're going to be getting the money in the future. You're going to receive it later. Where payables, you're going to be paying it later. Does that make sense? So receive, you're receiving, payables, you're paying. Okay, so, and that's with any accounts receivable. So accounts receivable is used for when you're selling to accounts that are set up with credit terms, whether it be services or products. And the terms are usually short term, like 30 days or maybe 45 days, 60 days if you're lucky. A lot of times it's not that long, but depends on your contract that you have. So your receivables are constantly turning around. Then we have notes receivable, and we'll go over that a little bit in the homework. But the notes receivable or an installment sale is something that's going to be usually over a longer period of time. It's a set amount and you get interest on it. So I'll give you an example. So in Chicago, we have a mall, and one of the tenants there had accumulated several months of rent that they couldn't pay. So they're just a little mom and pop store, and they were struggling through COVID and the closures and all that stuff. So a lot of it got built up. So what we did was we decided that we would go ahead and remove it off the accounts receivable, which is that short-term turnaround. We pulled it off of there and we set up a notes receivable, and we extended it for a long period of time. So that way he could just pay a little bit over time. Some of it got written off, some of it got set up as a notes receivable. So periodically you'll have that. Maybe you have a customer that bought some product and they're in the same situation and you've agreed to do this. Maybe you sold it that way because it was a large project. And they'll, you know, like, let's say they have a project that's about 50,000 and they say, okay, we'll give you credit terms. This is how much you can borrow from us. And then they'll set up that installment sale. So think about accounts receivable being like terms that are short term, they're constantly turning over. And then the notes receivable are for like larger amounts, usually something that's extended over a period of time, maybe 12 months or more, and they have interest that they'll have to pay.
I have a question.
Okay.
At what point does they go to collections? You know, like when collection agencies call and stuff?
Yeah, so every company is different. So some people do their collections in-house, and sometimes they outsource that. So I know that like with the medical industry, the outsourcing of the patient accounts has gotten, you know, really big. Now it's hardly ever they keep that billing internally. They will turn around and send you a bill, and if you don't pay it within the first 2 months, they'll send it to collections. And normally in that situation, they've either sold it where the company bought the receivable and now they're collecting. So they're able to negotiate, maybe take a little less money because they bought it for less. And sometimes they don't buy it right away. They're given those accounts, they collect. And when the money comes in, they turn it over to the organization and they get a fee for whatever they've collected. So they can do it different ways. And every company, the way that they do their collections is different. There's no set. So if you decide to sell to a collection agency, then normally you'll get the money up front. They take on the receivable and then they collect. And they can negotiate because they've probably bought it for less than what you owed initially. And then sometimes it could be, you know, like with a lot of the patient accounts with the hospitals, when they have an outsource, they will not sell them, but somebody's kind of managing those receivables. So it can be both ways, and every company is different.
Okay, thank you.
Okay. Hopefully this is still. It might have sat too long. Okay, so question 1. It says prepare a journal entry for the following credit card sales transactions. The company uses perpetual inventory system. So they're just telling you that in case there's merchandise involved, you'll have to know that it's going to cost of goods sold. Okay. So we're selling 25,000 of merchandise, which costs 19,000 on a MasterCard credit card sales. The MasterCard charges 5% fee. So we need to calculate the fee on what, the cost or the sale? What you think? On the sale. So it's going to be the 25,000. I don't know if this is going to let me write. Let me see. It'd be the 25,000 times the 5% fee. Okay, so my fee is going to be $12.50. All right, so that's how much I'm not going to get in cash because I have to pay that as an expense. Now, how much do I have to set up my sale for? The full amount of the 25,000. That's my revenue. I've sold 25,000. So even though I'm not collecting all of that, I have to record my sale for how much it was. So the entry is going to be the 25,000 less the 12.50. That's my cash I'm receiving. Okay, so I'm debiting cash, 23,750. And I'm setting up my fee. Remember, it's credit card fees or bank service fees. We're using credit card expense, $12.50. And I'm crediting my sales, my revenue account of 25,000. So that's my sale side of it. It also tells me that I had a cost of 19,000. So I want to record my cost to offset that revenue. So my cost of goods sold, this should be a recap from what we did. I think it was chapter 4 when we did merchandise. So it's cost of goods sold for 19,000 and I'm selling product. So I'm removing my inventory. So I have to credit inventory, $19,000. So I've just recorded the sale, my cash that I received, the expense for the credit card because I've used the credit card so I don't get all my cash. And then I've booked my sale and I've reduced my inventory. I have my cost of goods now on the books to offset my revenues. Okay, then I have, that didn't work out right. I know there was a button to clear the screen, but I don't remember where it's at. It only has that. Here it is. Okay. So we sell $5,500 of merchandise. The cost is $32.50 on an assortment of bank credit cards. These cards charge a 4% fee. So we have to look at the sale again, $5,500. Start switching. Times 4%. That's 220. So now when I book my sale, am I receiving all the cash? No, I have a fee that I have to pay out of that money. So I'm selling $5,500 worth of merchandise, but I'm getting $220 less because that's my fee for using the credit cards. The advantage is I'm getting my money up front. Okay, so I'm either going to sell it on credit and I got to wait 30 to 40 days to get the money, or I can take a credit card and just lose a little bit of money up front, but I've got the cash. It helps with your cash flow. So I debit the cash, $52.80, which is the difference between the $5,500 and the $220. I book my expense right here for the $220. So we're right here. And then I have my sales, my revenue for the $5,500, full amount. Remember, I want to book my sale for the amount of my sale. And then it tells me my cost of goods sold is $32.50. So I have to book my costs and remove my inventory. So I'm debiting cost of goods sold $32.50, and I'm crediting merchandise inventory for $32.50. Does that all make sense? So we're going to number 5. Okay, so now we have a bad debt. So Warner Company's year-end unadjusted trial balance shows accounts receivable of $104,000, allowance for doubtful accounts of $650 credit, and the sale of $330,000. Uncollectibles are estimated to be 0.5% of sales. So when I'm calculating my estimate from sales, do I need to know what's in the allowance account? Does that come into play when I'm calculating off of sales? No, only when I'm calculating based on a percentage of accounts receivable. So they're giving you the information, but you don't need all the information. Okay, so it's saying they're using the sales method. So they're going to take the 330,000, which is my sale amount, times 0.5%, and that's the 1650. So that's how I come up with what my estimate's going to be. It gave me my receivables, it gave me my allowance balance, but I didn't need either one of those because the method they want me to use to estimate is sales. So now, because this is when I'm estimating, I'm not determining at this point who is uncollectible and writing that off. I'm setting up the estimate for the new year. And so when I make the calculation, the estimate, that's when I expense the entire amount and set up my allowance account. So I'm going bad debt expense debit, $1650, and I'm crediting allowance for doubtful accounts, $1650. So all I've done is set up my estimate for the new year. It doesn't matter that I have a balance in there. Yes.
So on the actual homework, it's like 50% sales. So you multiply the 300,000 by 50%.
So what it's telling you, 50%? Seems high.
Yeah.
Whatever percent it gives you, that's what you want to use.
But I'm getting 150,000 and it's telling me that's wrong.
Okay, I can come look at it after. Just make a note that I need to look at number 5 for you. You sure it doesn't say 0.5?
It says 0.50.
Okay, so do 0.5%, which would be 0.005.
Okay.
So multiply it by 0.005 and then put that answer in and see. 50% seems kind of high. If you're not going to be collecting 50%, you're going to be out of business real soon, because usually that's a lot more than what you're making in your margin, right? Remember we talked about the margin, profit margin. Usually that hangs around, depending on the industry, but it could be somewhere around 20%, 25%. If you're in jewelry, I think jewelry's higher percentage than that, like 40%, but you don't want to lose 50%. Okay, at year end, December 31, Chan Company estimates its bad debt as 0.7% of its credit sales of $834,000. Chan records bad debt expense for that estimate. On the following February, Chan decides that the $417 account for P Park is uncollectible and writes off the bad debt. On June 5th, Park unexpectedly pays the balance. Okay, so first we're going to set up the estimate. Then we have somebody that we deem uncollectible and we write off, and then we receive the money for it. So we're going to walk through all 3 steps. So how do we calculate the amount that we're going to set up? We're doing sales. So it's just sales times the percent that they've given us. So we have credit sales of 834,000. And they're telling me it's 0.7%. So my allowance is going to be 5838 when you calculate that out. So here's my estimate that I'm setting up for the new period. So on December 31, I'm writing this up and it's going to go into the next year. And I probably won't do this process again until the next December. So I'm setting my allowance up for the next year. Okay, so I have bad debt expense. I debit that for 5838, and I'm crediting my allowance account for 5838. So now when we decide that Chan is not going to pay $417, we need to remove that receivable. We don't want to show that they owe us money any longer because we're not going to collect it. Maybe we've tried calling, we couldn't find them. So now I've decided I need to get rid of that accounts receivable. So am I going to debit bad debt expense? No, because I'm not doing the direct method. I already set up my allowance. I already expensed the bad debt. So now I just want to offset what I've estimated. And that is debit allowance for doubtful accounts for 417. And then I'm going to credit the accounts receivable for Park for 417. Then on June 5th, he pays the amount that was previously written off. Okay, so now I've collected money and there's no longer an account on the books showing that he owes money. So I have to reverse what I did. So on June 5th, I'm going to reverse what I did when I wrote it off. I'm going to put the accounts receivable back on the books as a debit accounts receivable for Parks, $417. And I'm going to credit the allowance because that's what I had debited, right? So I have to credit that $417. So I'm literally just reversing what I did. So it's just in reverse. And then now that the accounts receivable is back on my books, now I can receive the cash against it. So I debit my cash for the $417 and I credit accounts receivable to remove the receivable because now they don't owe because they paid. Okay.
So for part 1 with the bad debts and expense and allowance for technical accounts, to get that number for the debit and the credit, all you have to do is the 834 times 0.70.
0.7%. Mm-hmm.
So mine is 912,000 and I have a 30% or 0.30%. When I do that, I get 273,600. When I put those in, it's saying it's wrong.
930,000 times.
12.
What is it? It's 930,000.
912,000.
Oh, 912.
And then the percentage is 0.30.
Okay, so 912 times 0.30%. So remember, you got to do 0.003.
All right.
So it should be 2736 is what your allowance is going to be. So if you have a calculator that has the percent on it, I don't have that on here. It happens. I've been talking, sometimes teaching, and I'm doing the exact reverse of what I want to say. So it happens. But if you have a calculator, just put the 0.7%, hit the percent sign, and it'll calculate it for you. Or just do the 0.007. Okay, so now we have a note. And we have to calculate out the cash that we're going to receive and the interest that we're going to receive. Okay, so we're charging interest. On August 2nd, June Company receives a 7,000 90-day 11.5% note. Clear. From customer Ryan Albany as payment on his $7,000 account. So prepare the journal entry, assuming the note is honored by the customer on October 31, and round your answer to the whole dollar, and we're using 360 days. So remember, whenever we're doing the banking stuff, we're using that 360 as our denominator. Okay, so we have $7,000 on the note. So we're going to multiply that by the interest rate, which is 11.5%. So 7,000 times 11.5% gives you the interest for the entire year. We don't want the whole year. So we have to divide it by 360 to get what is the daily amount. So we're saying a 360-day year. So we take the amount divided by 360. That gives me my daily interest. And then I have to multiply it by the 90 days. Does that make sense? I got to calculate it out for the full year, but my loan's not a whole year. It's only 90 days. So I have to divide by 360 to get a daily amount, and then multiply it by how many days is the loan. It's 90 days.
I'm kind of confused on that one.
Okay, so they're receiving $7,000, a note for $7,000, charging the customer 11.5%. So I need to figure out in 90 days, when I get paid, how much am I getting? I'm going to get the 7,000 plus I'm going to get interest. Okay, so I'm giving them 90 days to pay me the money. In order to calculate the interest, I take the $7,000 times it by the percent, which is 11.5%. That amount gives me my yearly interest. I want to divide it by the 360 to come up with a daily number. And then how many days is the loan? 90 days. So I'll multiply it by 90. Does that make sense?
Yes, that makes sense.
Okay. So I get $201. So it's showing you the calculations here. 7,000 times 11.5%, times it by 90 and dividing by 360. I just said it the other way. I said divide by 360 to come up with your daily and then multiply it by 90. Same answer. $201. So this is the interest that I'm going to collect on that loan that I just did. I'm going to receive that money. So I'm going to have to record that as revenue because I'm receiving interest from a customer. So how much cash am I getting? The amounts of the loan plus the interest. So I'm getting the 7,000 plus the 201. So I'm getting 7,201. So this is my cash that I'm going to receive. So I debit cash for the full amount, 7,201. I have a note on my books for $7,000 because that's what I lent out, $7,000. So when I clear the note, I need to clear the note only for the principal amount because that's how much it was set up for. So here's my note to R. Albany for $7,000. And then the interest that I collected, I have to record that as revenue. So I credit interest revenue for $201. You know, how many questions? Let's look at number 10. So we record the sale of Bayless Company of $143,000 in accounts receivable on May 1. Bayless is charged a 4% factoring fee. So we're selling some of our accounts receivable, and we're going to have to pay this 4% fee. So I have $143,000 in accounts receivable that I'm selling. Now, I'm not going to get all the cash because they told me that I'm going to have to pay a fee. The fee is 4%. So my fee that I have to pay is this $57.20. So I'm just taking the $143,000, multiplying it by the percentage to come up with what is the fee that I have to pay to sell my receivables. The fee is the $57.20. So the cash that I get is the $143 less the fee. So I debit cash, $137,280. That's just taking the $143 less the $57.20. To come up with how much cash am I going to receive. This is my cash. This is my fee. So I put my cash in the books, $137,280. Then I have to record my expense. We're going to call it a factoring fee expense for $57.20 because that's how much they're charging me. And now I have to clear my entire receivable that I sold. So I credit accounts receivable for $143,000. So the way that they're doing this example is they're just doing one account that says accounts receivable for $143,000. If you have multiple customers on that report that make up that $143,000 in the system, you'll have to individually go to each one of their accounts and issue a credit memo so that it clears off all of those customers. So you don't have the report, you won't show up on the report anymore. Your accounts receivable will show 0 if the total is $143,000. So they're keeping it simple. They're saying we're going to accounts receivable because we're reducing it, but remember that's a control account, and we have a subsidiary that has a list of all these people that have to be cleared off.
So just to make sure, accounts receivables will always be like a credit, or will there be situations where it can be a debit?
Right. So accounts receivable is normally a debit when you have a sale. And
Okay.
so if you're selling services or a product and you don't receive the cash, it's an asset account. So it's going to be a debit. When they pay, how do we clear it? We got to do the opposite. We got to credit. In this situation, we're not collecting from the customers and clearing it. We're collecting from a company that's willing to buy our receivables. And so we have to clear it with a credit. So when you see the credit to accounts receivable, that means that it's being reduced. The accounts receivables are being reduced, meaning you have less money owed to you. Okay, so this is an accounts receivable that is going to break out the estimate based on the number of days outstanding. So I just wanted to go over it to make sure you understood what you have to do for this one. So Jordan Company has credit sales of $2.5 million for the year of 2018. On December 31, the company's allowance for doubtful accounts has an unadjusted credit balance of $15,980. Jordan prepares a schedule of its December 31, 2018 accounts receivable by age. On the basis of past experience, it estimates the percent of receivables in each age category that will become uncollectible. Okay, so here's your table that summarizes that. So if it's current, not due yet, they're saying maybe 0.95% we won't collect. As we get older, the percentage is going to increase because it's more likely that we won't collect. So I have 4,000 over 90 days. Well, I'm saying 65% probably won't collect because it's over 90 days. So I have a table that I got to figure out the estimate. So normally we've talked about doing an estimate with saying, okay, here's my total accounts receivable, which is 2.5 million. I think 0.5% is not going to be collected. And then I just take the 2.5 million, multiply it by the 0.5, and I come up with a number, and that's what I use to calculate for my estimate. This is a little bit different. Instead of just having one number, we're going to have it by age and then different percentages. So they want you to fill out the table. So we're basically just taking the information from the table, putting it in here. So it's just breaking down by the age, not due, 1 to 30, and we're just bringing those numbers down into the chart, okay? And then we want to know what is the percentage of that. Again, we're just taking it from the table here. We're going to fill that in. So 0.95% for what isn't due yet. So I'm putting that in on my table. I'm going to calculate it out. How do I calculate that out? 500,000 times 0.95% is going to equal 4750. So I'm just calculating it out, each age on what they've given me. Each amount is going to go here for each age, and then I'm going to total it up. So if this is going to be my estimate, it wants to know, is it going to be a debit or a credit? Well, when I'm setting up my estimate, what's my debit side? Do you remember what we did one earlier? What are we debiting when we're calculating our estimate for the next year? And we have to set it up. What is our debit? We're just doing an estimate of what we think we're not going to get. We're not collecting anything. That is part of it, but it's not going to be the debit. What is this called that we're doing? Why are we calculating this out? We think that this is going to be what? Bad debt. So we're going to debit bad debt expense for an amount, and we're going to credit an amount of allowance of doubtful accounts. So we're coming up with an estimate. Well, we want the balance in the allowance account, because we're using the receivable method. We want that balance to be the 19,480. So the next part of the question is going to ask you, what is the journal entry? So we got to look and see, what did it tell us? So it's telling me right now, my balance is 15,980. So let's go here for a second. So here's my allowance. It said 15,980, I think, right? That's my credit balance. When I calculate all my percentages for each age group, I come up with 19,480. So this is my balance right now. I want a balance of 19,480 as a credit, because this is what I want on the books going into the next year to have as an allowance, so that each time I deem a receivable not collectible, I'm going to debit and offset this 19,000. So if I want this account to have a balance of 19,480, do I need to do a debit or a credit to this account? Am I adding or subtracting to it? Am I adding or subtracting? Like at 15,980, I need to get to 19,480. Am I adding or subtracting?
You're adding.
We're going to add.
Adding.
So how do we add? It's got to be on the same side in order to add. So my allowance account, I need to take the difference between these two numbers.
That difference is $3,500, I believe.
35?
Yes.
Okay, so we have a difference of 3,500. So my adjustment, in order to get my account to equal this balance, I need to do a journal entry of $3,500 to make that happen. So I went through the process of calculating this out, and I have $19,000. But you see how when you do the receivable method, you're not going to use that amount to do your journal entry. You're just using that to figure out, okay, where's my allowance account? Because this is what I want my balance to be, and how do I get there? So in this example, I have to do an adjustment to add to it, which means I have to do a credit to my allowance. So here's my journal entry. I'm going to set up an additional expense of $35,000. So maybe I had a different estimate last year, and I went through the year and I wrote off people during the year, and I was left with that 15,000 as a balance. So maybe I didn't use all the money, right? Because this year, maybe I wrote off a lot more last year. Maybe the last year was 30,000 that I had to expense. This year, it's only 3,500 in order for me to get there. So even though the calculation was 19,000, that's not my adjustment. My adjustment's going to have to take into consideration what is already in the allowance account. So this year, I do an entry, I debit bad debt expense for 3,500, and I credit my allowance for doubtful accounts for 3,500. So this is the most complicated one. So remember, we have two ways to calculate our allowance. The first one is on sales. So if I say that I am not going to collect 2% of my sales, then that's the number I use to do this entry. Bad debt expense will be that number. I don't have to look at allowance for doubtful accounts because I'm not looking at what do I want that account to be? What do I want that account balance to be? I'm just going to calculate it on my sales. Now, this method is looking at the accounts receivable, and it's saying, okay, this is how much I think I'm not going to be able to collect. And so that's what I want to have on my books in my allowance account. And it's going to take into consideration what is already there. In this example that we just did, we had to credit in order to increase the allowance account. What if it was the opposite? What if I needed to be, let's say I calculated everything out. So let's say my allowance had 15,980. And I want my balance to be 14,000 credit. So here's my credit balance right now, 15,980. So I need to increase or decrease that number if I want to get my balance to 14,000.
Decrease?
Decrease. So I need to decrease my account. Well, how do I decrease it? With a credit or a debit?
Credit.
With a
If I put
debit?
If it's going to be a debit, if I put a credit, it's going to increase it over here because it's on the same side. So I'd have to add them together. If I need it to decrease the account and I have a credit sitting there, then I have to do the opposite in order to reduce it down. So my difference, I take the 15,980 less the 14,000, which is 1980, I believe. So I have to reduce it by that. So now I need to do a journal entry for 1980 in order to get a balance of $14,000 as a credit. So my entry would be bad debt expense 1980, and I would credit my, oops, sorry. See, here's one of those moments. I'm doing the opposite of what I'm saying. I need to debit allowance for 1980, and I credit bad debt expense for 1980. So maybe last year had a really big expense. And then, you know, I wrote off during the year, and then I made some really good collections. This year's been better than last year. Maybe the stores are back open because we don't have COVID. And so people have more sales, they're able to pay off their accounts. So now when I calculate on my accounts receivable is lower. I don't have as much money outstanding. So when I do the percentages, the number goes down, which means I have to decrease. So now instead of having an expense this year, I wound up having a credit to my expense, which is to my benefit. And in order to get the balance I need, I have to do the opposite because I want to deduct it. Does that make sense? So even though it's sitting up here in this example, it's sitting as a credit balance, and I still want a credit balance. In order to increase it, I still have to credit. A little bit confusing, but makes sense? So yeah, I feel like you're a little whiz at accounts receivable now. Y'all ready to all go be accountants and work in the accounts receivable department?
Oh,
He
no.
shook his head no.
Uh,
You would not get fired. Not if you tried hard. What did you say online? You said no way?
No way.
Do I have any of my accounting students, accounting majors in here? One?
I'm actually, yeah, I'm an accounting major also, so
Is that Raheem?
yeah.
Okay, so I have two accountants, potential future accountants in here. So maybe you'll be a management for receivables when you're done. And you'll be looking at the accounts receivable reports like we looked at tonight and making sure they're doing their collections and making sure everybody's making the deposits in a timely manner. Remember, last week we talked about cash management. We want to make sure that accounts receivable department is collecting the money, right, to keep the cash going. We don't have anybody collecting or billing. What happens? The cash flow stops, right? So I'm gonna tell you a quick story and then we'll be done. So my father-in-law, I love him to death, but he's got an AC company and his wife is John, my husband's stepmom. It's not my mother-in-law. So, well, let's just leave it at that. So anyway, she has a lot of issues and it's either, you know, she's had some illnesses. She wound up with hepatitis from a blood transfusion. So she's got excuses. So she has some bad days. But what happens with the business, she does all of collecting the money, getting the money in the bank, making sure everything's posted on the account, making sure things are reviewed to bill the invoices. She's the one that's managing the cash flow coming in. And so what happens is there's days she'll go and she won't go through the paperwork and turn it in. My mother-in-law actually works for the company. So she's waiting on paperwork to come in. So what happens is my mother-in-law can't bill the customers. So they've done all this work all week long and she has no invoices to bill to the customers. So what happens? Those customers aren't getting billed. Do you think you're going to get collect on the money if you're not sending bills out? No. So accounts receivable is extremely important to make sure those bills are getting billed. The other problem she has is the checks will come in and they'll sit on the desk and she's not at the desk. So she's not writing up a deposit and bringing it to the bank. It's just sitting there. So my mother-in-law will run an aging report. Well, guess what? When she's looking at accounts receivable report, the one that we were looking at earlier in the beginning, where it shows you who owes you money, what happens if the money never got deposited? She's looking at money that needs to be collected, but does it need to be collected? Probably not. It's sitting on somebody's desk. So then that interferes because she's not calling because she's gotten burned too many times. She's not picking up the phone to call anybody to say, hey, you owe me money. Because why? They probably already paid. She just didn't do her part of taking that money and bringing it to the bank. So then what happens? Now there's no cash in the bank because it's sitting on her desk. So then they have parts that they're buying all the time. And some of this equipment for HVAC is expensive. And so then there's a cash flow problem because people aren't getting billed in a timely manner. Deposits aren't getting put in. Collection calls aren't happening. So you see how the cash management part that we learned last week ties into the flow of accounts receivable. It's important that everybody's doing their job in those roles and the accounts receivable. And there's plenty of different little roles in accounts receivable. So there's a lot of different aspects to that. So if you worked at a large corporation, you may work in the accounts receivable department, and that's all your focus is managing the flows happening through there. I mean, would you like, if you couldn't order the products that you needed because you're on vendor hold, because why? They didn't make a payment, because they didn't have the cash in the bank to make the payment. So now you can't order beds. What do? Everything stops, right? So it affects everybody. So he's not in accounting. He's just working over in the supply chain part of the business, and he can't do his job because what happened in accounting. So when you're in business, you're going to have some part is going to touch accounting. And so it's important that you understand what's happening in the accounting department in order for you to be able to be successful at your job in finance or marketing or whatever. You want to make sure your information is relevant and it's useful, right? You don't want crap coming out. So that's why it's real important to learn how, for the future accountants, learn what's happening so that you can see the big picture going into the financial statements, but also for those positions that are going to be within the organization that are working with accounting, right? So you got to understand what's supposed to be happening in order to be successful at your position. Okay, so do y'all have any questions? And I do love my stepmother-in-law, but she's got some issues. So we're good? You ready to get out of here because it's like really hot?
It's very hot.
For those that are online, y'all are lucky because it's really hot in here. Okay, so email me if you have any questions.